The FTSE 100 staged a modest recovery on Wednesday, but beneath that headline number, UK gilt yields are telling a story equity prices are still refusing to admit. The 10-year gilt yield peaked at 5.10% this week, levels not seen since the 2008 financial crisis. And the question is not whether that move was large, but why the UK absorbed more of the inflation shock than any other major economy. The mechanism starts in the Strait of Hormuz. More than 10 weeks after the US-Israeli strikes on Iran, the waterway that normally carries a fifth of global seaborne crude remains effectively closed. The IEA confirmed that global oil inventories were drawn down by 250 million barrels across March and April, 4 million barrels per day, a rate it called unprecedented. Brent crude peaked above $141 in April and was still above $107 on Wednesday. That sustained oil price is not a spike. It is a repricing of energy costs that flows through to every input price in an import-dependent economy. That transmission is the problem for Britain specifically. UK inflation is re-accelerating at a moment when the Bank of England had been expected to cut rates multiple times this year. US CPI jumped to 3.8% in April, the highest in 3 years, with core rising to 2.8%. Fed funds futures now price an 80% probability of a rate hike by April 2027. For the Bank of England, the calculus is nearly identical, except that the UK carries an additional structural vulnerability. It imports a higher share of energy and petrochemicals than the Eurozone average, meaning the same oil shock produces a larger domestic price impulse. The rate cut expectations that had been driving gilts higher through early 2026 are now being unwound, and the sell-off in UK sovereign debt is the visible result. What makes this more than just an energy story is that gilt yields have risen by a full percentage point more than equivalent bonds in comparable economies since the war began, a spread that cannot be explained by oil prices alone.
The additional spread in UK gilts points directly to Westminster, where the political crisis triggered by last week's local election results is compounding the inflation shock into a distinct risk premium on British assets. Labour lost more than 1,000 municipal seats, mainly to reform in the Greens, and the fallout arrived in financial markets before it resolved in Parliament. The mechanism is specific. Bond investors are pricing the probability that Starmer's replacement would either loosen fiscal rules or pivot towards inflationary spending. The yield on 10-year gilts rose 20 basis points in the 2 days after the election results alone, a move that came entirely on top of the Iran-driven repricing already underway. Sterling fell 0.7% against the dollar in that same window, an unusually correlated move. Normally, higher gilt yields attract capital and support the pound. The fact that sterling and gilts fell together signals that investors are treating the UK not as a high-yield opportunity, but as a risk asset requiring a discount. Investors' assessments of leadership candidates are now openly driving bond pricing. Andy Burnham, who said last year that the country should not be in hock to the bond market, is considered by market participants the highest risk replacement scenario. Wes Streeting, who is expected to formally challenge Starmer, is viewed as a continuity candidate who would maintain current fiscal rules, and gilt yields eased 3 basis points on Wednesday as the Streeting challenge appeared to crystallize rather than detonate into a wider left-wing bid. Goldman Sachs estimated the combined effect of political uncertainty and higher yields would reduce the Chancellor's fiscal buffer by £12 billion. That 3 basis point easing is where the tension sits. It is a relief move, not a resolution, and the distinction matters for positioning.
The gilt sell-off and the political discount on UK assets are not only a bond market story. They are the conditions under which the third wave of FTSE 100 delistings becomes rational, and Intertek's agreement to consider EQT's $10.6 billion takeover bid shows the mechanism working in real time. Intertek rejected 3 previous bids at £51.50, £54, and £58. It is now minded to recommend the £6 offer, and its shares jumped nearly 7% on Wednesday. The reason the price finally reached acceptance is not that the company's fundamentals changed. It is that London-listed valuations have been structurally depressed by the same conditions compressing gilt prices: an energy inflation shock, a political uncertainty premium, and an equity market that has underperformed European and US peers for the better part of 2 years. EQT, priced in Swedish krona against a weakened pound, can afford to pay more than the market because the market itself has been discounted. Intertek is set to become the third FTSE 100 company acquired by foreign entities in 2026.
Private equity's liquidation of London-listed assets has been building since gilt yields began their climb, because a higher cost of capital compresses the terminal value that domestic investors can justify paying, while foreign buyers face a lower effective acquisition cost as sterling weakens. The house builder Vistry delivered the same signal from a different angle. It warned of significantly lower first-half profits after being forced to cut home prices to clear demand that has dried up in the face of mortgage rate uncertainty driven by the same gilt yield move. Vistry shares fell 10.5% to their lowest level in nearly 15 years. The leaning here tilts toward continued UK asset discount rather than recovery, but the condition that determines which way this resolves is the Streeting leadership timeline. If a formal challenge confirms him as the continuity candidate and Starmer's departure is orderly, gilt yields could retrace toward 4.8%, the level priced before the election results, and the foreign acquisition discount on London assets narrows. If a wider left-wing contest opens, or if oil fails to fall below $100 as the Iran ceasefire remains fragile, the gilt yield at 5.07 is the floor, not the ceiling. The verification benchmark is Thursday's gilt auction. If 10-year demand comes in weak at a yield above 5.1%, the IEA's unprecedented supply shock language and the Goldman $12 billion fiscal warning are already being priced as the baseline, not the tail risk. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.